Central bank meetings are like blind dates. You never know what to expect, but you hope for the best. In this video, we will explore how central bank meetings affect Asian currencies and why they are so important for traders and investors. Central banks are institutions that manage the money supply and interest rates of a country. They have a lot of influence on the economy and the financial markets, especially the foreign exchange market. Central banks hold regular meetings to review the economic situation and decide whether to change their monetary policy or keep it unchanged. When a central bank meeting is approaching, traders and investors pay close attention to the signals and clues that the central bank officials give about their intentions and expectations. These signals can be found in speeches, interviews, reports, surveys, and other sources of information. They help to form the market consensus about what the central bank will do and how it will affect the currency. However, sometimes the central bank surprises the market by doing something different from what was expected. This can cause a lot of volatility and uncertainty in the currency market, as traders and investors adjust their positions and expectations accordingly. A surprise can be positive or negative for the currency, depending on whether it implies a more hawkish or dovish stance from the central bank. A hawkish stance means that the central bank is more concerned about inflation and growth than about stimulating the economy. It usually implies higher interest rates or tighter monetary policy, which tend to strengthen the currency. A dovish stance means that the central bank is more concerned about supporting the economy than about controlling inflation and growth. It usually implies lower interest rates or looser monetary policy, which tend to weaken the currency. For example, if the market expects that the Bank of Japan, BOJ, will keep its interest rate unchanged at -0.1%, but the BOJ unexpectedly cuts it to -0.2%, this would be a dovish surprise that would likely weaken the Japanese yen against other currencies. On the other hand, if the market expects that the Reserve Bank of Australia, RBA, will cut its interest rate from 0.1% to 0%, but the RBA unexpectedly keeps it at 0.1%, this would be a hawkish surprise that would likely strengthen the Australian dollar against other currencies. Of course, not all surprises are equally impactful. The magnitude and direction of the currency reaction depend on several factors, such as the size of the surprise. How much did the central bank deviate from the market consensus? The direction of the surprise. Was it more hawkish or dovish than expected? The context of the surprise. What is the overall economic situation and outlook of the country? The communication of the surprise. How did the central bank explain its decision and its implications for future policy? The reaction of other central banks. How did they respond to the surprise and what does it mean for their own policy? These factors can make central bank meetings very exciting and unpredictable events for currency traders and investors. They can also create opportunities for profit or loss, depending on how well one can anticipate and react to them. That's why it is important to follow and understand how central bank meetings affect Asian currencies and what they reveal about the economic health and prospects of each country. In this video, we will analyze some of the most influential central banks in Asia, such as the People's Bank of China, PBOC, which controls the world's second-largest economy and has a complex exchange rate regime that involves a managed floating system with reference to a basket of currencies. The Reserve Bank of India, RBI, which oversees one of the fastest-growing emerging markets and has a flexible inflation targeting framework that aims to balance price stability and growth. The Bank Indonesia, BI, which governs Southeast Asia's largest economy and has a dual mandate of maintaining exchange rate stability and supporting economic recovery amid external shocks. The Bank of Korea, BOK, which manages Asia's fourth-largest economy and has an inflation targeting regime that focuses on price stability, as well as financial stability. We will also look at some of the key indicators and events that influence their monetary policy decisions, such as inflation. How fast are prices rising or falling in each country? Growth. How strong or weak is each country's economic activity and output? Trade. How much are each country's exports and imports affected by global demand and supply conditions? Fiscal policy. How much are each country's government spending and revenues affecting its fiscal balance and debt level? Geopolitics. How much are each country's political and security issues affecting its economic stability and relations with other countries? By the end of this video, you will have a better understanding of how central bank meetings are like blind dates for Asian currencies. You never know what to expect, but you hope for the best. You will also learn how to prepare for them and how to react to them, so that you can make the most of your trading and investing opportunities in the Asian currency market. Have you ever been on a roller coaster? If you have, you know how thrilling and scary it can be. You never know when you will go up or down, or how fast or slow. You just have to hold on tight and hope for the best. Well, that's kind of how Asian currencies are. They are like roller coasters that go up and down depending on the mood of the central bankers. Central bankers are the people who control the money supply and interest rates in a country. They have a lot of power and influence over the economy and the markets. When central bankers are in a good mood, they tend to lower interest rates and increase the money supply. This makes borrowing cheaper and stimulates spending and investment. This also makes their currency weaker compared to other currencies. A weaker currency means more exports and more tourism, which boosts the economy. But when central bankers are in a bad mood, they tend to raise interest rates and decrease the money supply. This makes borrowing more expensive and slows down spending and investment. This also makes their currency stronger compared to other currencies. A stronger currency means less exports and less tourism, which hurt the economy. So how do we know what mood the central bankers are in? Well, we have to pay attention to their meetings. Central bank meetings are when they announce their decisions on interest rates and money supply. They also give clues about their future plans and expectations. These meetings are very important for traders and investors who deal with Asian currencies. They can cause big swings in the exchange rates and affect the profitability of their trades. That's why they watch them closely and try to anticipate their outcomes. But sometimes, the central bankers surprise us with unexpected moves or statements. They can change their mind or their tone without warning. They can be hawkish or dovish, optimistic or pessimistic, aggressive or cautious. They can make us feel confident or nervous, happy or sad, excited or bored. And that's when the roller coaster ride begins. The Asian currencies start to move up and down rapidly, following the mood of the central bankers. Sometimes they go up together, sometimes they go down together, sometimes they go in opposite directions. It's hard to predict and hard to keep up. So what can we do to survive this roller coaster ride? Well, we can do what we do on a real roller coaster. Hold on tight, enjoy the thrill, and don't panic. We can also use some strategies to protect ourselves from losses and take advantage of opportunities. For example, we can use stop-loss orders to limit our downside risk. We can use take-profit orders to lock in our gains. We can use hedging techniques to reduce our exposure to currency fluctuations. We can diversify our portfolio to balance our risks and rewards. But most importantly, we have to remember that this roller coaster ride is not permanent. It will eventually end and stabilize. The Asian currencies will find their equilibrium based on the fundamentals of their economies and markets. The central bankers will calm down and become more predictable. Until then, we have to be prepared for anything and everything. We have to be flexible and adaptable. We have to be smart and savvy. We have to be brave and bold. Because that's what it takes to trade Asian currencies in a world where central bank meetings affect everything. How to make money from currency fluctuations. A simple guide to hedging, arbitrage and speculation. Currency fluctuations are changes in the value of one currency relative to another. They are influenced by various factors such as interest rates, inflation, trade balance, political events, and market sentiment. Currency fluctuations can create opportunities and risks for investors who deal with foreign exchange. There are three main strategies that investors can use to profit from or protect against currency fluctuations: hedging, arbitrage, and speculation. Hedging is a strategy that aims to reduce the risk of adverse price movements in an asset by taking an opposite position in a related asset. For example, if you have a business that exports goods to another country and you expect to receive payment in that country's currency, you can hedge your exposure by buying a futures contract that locks in the exchange rate at which you will sell that currency. This way, you can avoid losing money if the currency depreciates before you receive the payment. Arbitrage is a strategy that exploits the price differences of an asset across different markets. For example, if you notice that the same currency pair is trading at different prices on two different exchanges, you can buy the currency pair at the lower price and sell it at the higher price, making a risk-free profit. Arbitrage opportunities are rare and usually disappear quickly as the market adjusts to eliminate the price discrepancy. Speculation is a strategy that involves betting on the future direction of an asset's price based on your expectations or assumptions. For example, if you believe that a certain currency will appreciate due to favorable economic or political conditions, you can buy that currency and hope to sell it later at a higher price. Speculation is a risky strategy as it involves taking on more exposure to price volatility and uncertainty. Hedging, arbitrage, and speculation are different ways of dealing with currency fluctuations depending on your goals, risk tolerance, and market outlook. Hedging is more suitable for investors who want to reduce their exposure to currency risk and stabilize their returns. Arbitrage is more suitable for investors who have access to high-speed technology and information that can help them identify and exploit price differences across markets. Speculation is more suitable for investors who have a strong conviction about the future direction of currency movements and are willing to take on more risk for higher returns.